The healthcare sector is attractive for investors focusing on dividend growth stocks due to recession fears and a potential decrease in private consumption. Thermo Fisher stock ticker TMO has experienced significant growth over the past 20 years with a 14% CAGR in revenue and a 17% CAGR in adjusted EPS. They are currently trading at $525. Year to date, they are down 5%, and over the last year, they are down 3.4% roughly. They are already starting to build up a nice dividend streak, so let's take a look here. Consecutive years of dividend growth, 5 years. Consecutive years of dividend payment, 10 years. So looks pretty good. They did have some years in the start, early 10s here, where they didn't have that much growth, and after that, they started actually to build up the dividend quite heavily. So let's jump into a stock screener to actually take a look at the intrinsic value of Thermo Fisher. And while we wait for everything to populate here, you can see the PE non-GAAP forward ratio is around 20, which is roughly in line with the 5-year average. The dividend yield is very, very low, 0.25%, and the payout ratio is 7.8% just. So there is a massive room for growth of the dividend for Thermo Fisher going forward. The 52-week low is $475, 52-week high is $611. So we are roughly a bit in the middle of that. The analyst target price is $626, EPS growth 23%, and the return on equity at 14%. Jumping into the dividend data, and let's zoom in a bit so we can see everything a little bit better. You can see here a massive amount of green numbers in the first table. I want to take a closer look here. I want to see some consistent dividend growth. So as you can see here, it started as a 10, 12, then around 15, 17%, and then get back here to 16 and 15% roughly. So the 10-year growth average is around 8.3% actually. But take a look here at the last couple of years. We have had 15, 17, 16, around 15%. So looking forward, I would definitely think that they are looking to grow the dividend quite heavily. Coming down here to the dividend yield graphs, as we see earlier, whenever it goes above the line into the blue area, it could potentially indicate a undervalue, at least according to the dividend yield theory. And below it is in the red area, could indicate that it is indeed overvalued. And as we take a look at the graph on the left, it could potentially be at an 11% discount right now, at least according to the dividend yield theory. Looking down here at the cumulative rate of return, the time-weighted return, you can see the red line is the S&P 500 and TMO is in the green line. So if you had just invested in Thermo Fisher, you would be massively ahead of the index at the current time. But let's jump into the first model where we do have the discounted cash flow model. We take the free cash flow from the different years. We then apply a growth rate for the future free cash flows. In this case, I've used 10%, even though the average growth is at around 18%. Using this growth rate, we can then project the future free cash flows. We then have a discount rate of 9% that brings us back to the present value of those future free cash flows. Thumbing all that together with the cash and cash equivalent, the total debt, and the shares outstanding, we arrive at a fair value of $369. The next one is a dividend discount model. In this case, again, we do have a very, very high growth rate compared to the weighted average cost of capital. So as you see here, we do arrive at a negative intrinsic value. So we'll be then excluding this one in the future. Next up is the multiples variation, where we do take some of Thermo Fisher's peers, their PE multiples, combine that with the EPS of Thermo Fisher to arrive at a stock price of $453. Next up is the price to earnings variation, where we do take the price to earnings ratio from the different years. We then average the 5 last years together. We arrive at around 30, and then combine that with the trailing 12 months EPS, arriving at an intrinsic value of $473. Next up, Graham's revised variation model, where we do take the EPS of Thermo Fisher, the growth rate combining for the next 5 years, the average yield of AAA corporate bonds, and the current yield of AAA corporate bonds. And as you can see in the formula here, we combine everything together to get an intrinsic value of just $225. I do not believe that Graham's revised valuation model is a very good model for companies like Thermo Fisher. So let's jump to the next one, which is the free cash flow valuation. Similar to the price to earnings valuation, we do take the price to free cash flow ratio from the different years. We then average all the 5 last years together into an average of around 30. We get the free cash flow per share from the different years. Combining that, we arrive at an intrinsic value of $436. Next up is the Peter Lynch model, where we do take the growth rate, the dividend yield, and the PE ratio from Thermo Fisher. Combining it together using Peter Lynch's formula, we arrive at an intrinsic value of $235. Before we jump into the summary, thank you so much for watching, and if you've come so far and don't subscribe already, please do so and like the video. Let's jump into the summary, where you can see we do have the valuation method lined up here, all 6 of them. So let's take a closer look, because the dividend discount was to be excluded since it's negative, and I also do believe that Graham's and the Peter Lynch valuation do not really match the growth rate that Thermo Fisher is exhibiting. So even though that we exclude some of those, we arrive at an average intrinsic value of $433. With the current price being $525, the average current discount is at a negative 21%, indicating that it could be undervalued. But if you take a closer look together with the dividend yield theory, it could potentially indicate, and obviously also the PE ratio, it could potentially be that it is at roughly fair value right now, but there is no margin of safety if you do believe in the company and want to invest at the current time. I personally think that Thermo Fisher is a very exciting company and I do really want to invest in them. I don't think the timing is right now. I don't think that the healthcare is done dropping. And also I do believe at the current time, with the average price being that much higher than the intrinsic value, I really want to have this margin of safety at least somewhat closer to the intrinsic value rather than having a negative 21% margin of safety. So in this case, or in my case at least, I really want to get into the stock, but I do want to wait out a bit for. So for me right now, I would definitely wait out a little bit more to see whether or not it will drop. But if you do believe in the long-term outlooks of Thermo Fisher, I don't think it's a too bad time to start to average into the stock. Thank you so much for watching, and I'll be seeing you in the next video.